Welcome to the Question Crunch video on what probably is a pretty difficult topic for many candidates, or at least a challenging one, namely the computation of diluted EPS. Hopefully, with the solving of these, I think we've got 15 questions here, you're going to no longer find this such a challenge. You'll actually probably find this relatively easy because, to be honest, the computation of diluted EPS really boils down to knowing just a few, let's say, not so natural and logical, nevertheless pretty simple computations. Okay, we're going to start off with a few, let's say, theoretical questions, and then move on to the computational ones. The computational ones being probably more likely to be akin to what you'll face in the exam. So let's get on with it. Obviously, feel free to first download the note with the note template with the questions. You may want to solve these before I solve them with you, or indeed solve them as we go along. But you'll find the link to the note template in the video description. A company has a simple capital structure that includes no potentially dilutive financial instruments. How does its diluted earnings per share compare to its basic earnings per share? And you've got three choices, including B and C. Diluted earnings per share is always lower, or diluted earnings per share cannot be calculated. Well, that last one is not true. We always show both basic and diluted earnings per share. And it's not the case that diluted always has to be lower. It may be equal to basic earnings per share, which is precisely what we show when there are no dilutive instruments, potentially dilutive instruments, or even if there are potentially dilutive instruments, but they turn out to be anti-dilutive once we do the computation. So in the case of there being no dilutive instruments, we basically report two numbers, basic and diluted EPS, which are exactly the same. And you'll see more questions which involve computation where we will come to the same conclusion. Number two, under the if converted method for convertible preferred shares, what two effects does the assumed conversion have on the diluted earnings per share calculation? Now, the if converted method is what we use when we've got convertible preferred shares and convertible bonds. That's the method we apply here. Now, the question only asks for what happens when we've got preferred shares of convertible nature. So we make two adjustments, an adjustment to the numerator, an adjustment to the denominator. In the case of the numerator, where we've got as the first sort of piece of data, we've got net income. What you're going to assume that if the preferred shares do indeed convert, you will no longer have to pay the preferred dividend. So that preferred dividend will no longer be deducted from the numerator, whereas in the denominator, we assume an increase to the number of shares because the preferred shares have converted. So let's have a look. The answer A, the share count rises and the preferred dividend is no longer deducted from net income. That is precisely what happens, and we're going to obviously apply that in questions in just a moment, numerical questions in just a moment. The others are wrong, even if you read just the first part. The share count falls, no, it doesn't fall, and the share count is unchanged, no, it's not unchanged. It rises due to the assumption of new shares, new ordinary shares being created. Once again, the if converted method being tested in the next one. Under the if converted method for convertible debt this time, what adjustment is made to the numerator on the diluted earnings per share calculated? Just asking about the numerator, so the top of the fraction. Right. If you assume that convertible debt stops being debt and becomes ordinary shares, you no longer pay interest. Now, interest by default is already in the net income computation. So what actually happens is you need to add the interest back to net income to show that it is no longer being paid. But remember, we always do it on an after-tax basis. The reason for after-tax, and that makes answer B the correct one, using after-tax is that, as we will, I think, explore in a later question as well, is that, the payment of interest has two effects. Yes, it is a cost, but it also provides a tax relief in the form of the tax shield. So when you stop paying interest, or you assume that interest stops being paid, you have to think about the net effect, which is always the after-tax effect. Number 4, under the Treasury stock method, that's the method we use when we've got options on shares for stock options. What is assumed to happen with the cash the company receives when the options are exercised? And if you followed my video on the computation of diluted earnings per share, you will remember the logic, hopefully, of that computation. We assume that any proceeds from the exercise of the share options are used to repurchase shares in the market. So that is absolutely in line with answer A. It is used to repurchase common shares at the average market price during the period. Okay, and now, on to the what will, for the rest of the video, be mainly computational questions. Not only a few theoretical ones still in there, but computational mainly. A company reports net income of 1,200,000 USD and has 400,000 weighted average shares outstanding. It also has 20,000 convertible preferred shares, each paying an annual dividend of $5 and convertible into 4 common shares. What is the diluted earnings per share? Okay. Before you start computing any diluted earnings per share, it's important to remember that we ought to start off with basic EPS. Why is that? So as to be able to compare whether the instrument, in this case, those convertible preferred shares are indeed dilutive, because if it turns out that they're not, you have to report as the correct answer the basic EPS, not the diluted EPS, if it's higher than basic. Okay, so we start off with basic. We take the net income of 1,200,000 from up here. And right, what do we need to do? In the basic EPS fraction, what you're supposed to show in the numerator is the net income available to ordinary shareholders. Now, from the net income figure, the company still needs to make a payment to the preferred shareholders who receive a preferred dividend. So if that company has 20,000 convertible shares, and each one of those is supposed to, pay its holder a dividend of five each. So we have 20,000 times $5. It will only be after this negative adjustment that we can arrive at the net income available to the ordinary shareholders, who, of course, in the hierarchy of receiving payments, come after preferred. And we divide this by the number of weighted average number of shares outstanding during the period, which was 400,000. So now my calculator, which you've been seeing, on the screen, will come in useful. 1,200,000 minus 20,000 times 5. Okay, and we divide that by 400,000 equals 2.75. So that is my basic earnings per share. Okay, it's only the basic earnings per share figure. It's not the answer yet, although in the end it might end up being the answer. It all depends on what we get for diluted earnings per share. Right, the DEPS starts off with net income as well, and now we assume that the shares have already converted. So what happens then? We, of course, no longer have to pay this preferred dividend. So we omit it from the numerator of the fraction. And this is pretty much what was asked, I think, over here in question 2. Under the if converted method for convertible preferred shares, what 2 effects does the assumed conversion have? The share count rises, that will be in the denominator, but also the preferred dividend is no longer deducted from net income. So I stopped making any deduction because I assume the preferred shares no longer exist. But in the denominator, I do absolutely make sure to increase the number of shares outstanding. So it's going to be the previous 400,000 shares, but now raised or increased because these 20,000 convertible instruments, each one of those converts into 4 ordinary shares. So we effectively have 1,200,000 of income to be distributed among 480,000. Yeah, that's right, 480,000 shares. That gives 2.5. That's it. That's the computation of diluted earnings per share, because DEPS, the computation, provided a number which was lower than basic EPS. We stick with that one. We stick with DEPS and report it as the number. So that was number 5. Hopefully not so bad. Let's now move on to question 6. A company reports net income of 750,000 and has 300,000 weighted average shares outstanding. It also has some convertible bonds carrying a 5% coupon, convertible into 12,000 common shares. The tax rate is 25%. What is the diluted earnings per share? Okay, just like before, we start off with the basic EPS computation. So basic EPS, taking that net income 750,000. Now, for basic EPS, you also always have to think about the net income available to ordinary common shareholders. And in the case of a company that has preferred shares, we need to deduct that preferred dividend. Why? Because the preferred dividend is never deducted from net income in the financial reports. You have to deduct it after net. Preferred dividends come after net income. But when you've got convertible bonds that pay a coupon interest, you can be absolutely sure that the interest has already been deducted in arriving at the 750,000 of net income, because interest always is an expense that appears before net income. Dividends appear after net income, and they're not really an expense because distributions to shareholders do not qualify as an expense in financial reporting. So we stick with the 750,000, making no deduction, and we simply divide that number by 300,000, the number of shares outstanding. I took that from over here, so 750,000 divided by 300,000. It's going to be a relatively simple computation, isn't it? 2.5. Okay, so let's now do diluted earnings per share, see what that number is. Take the same 750,000 that we had before, and now, assuming the convertible bonds indeed convert into shares, you will no longer have to pay, the company will no longer be paying the interest. So the interest was 5% on, I guess this is the nominal value. I mean, assume it is the nominal value of the bonds. $100,000 worth of convertible bonds carrying an annual interest of coupon of 5%. So that's going to be our sort of gross saving. But once you factor in the tax shield, so the fact that paying interest brings a tax saving, we need to kind of multiply that by 1 minus 25%. So effectively 75% of that is the benefit. So we adjust the numerator thus, and this was actually asked over here in question 3. Under the if converted method for convertible debt, what adjustment is made to the numerator of the diluted earnings per share calculation? And the answer I highlighted here as being the correct one is after-tax interest on the convertible debt is added back to net income. Just precisely what I've done over here. We divide this by the number of shares, but adjusted for the conversion. So the previous number of shares, 300,000, is there. But now we also take into account the fact that these shares are convertible. These bonds are convertible into 12,000 common shares. So making that adjustment, let's see what that gives. 750,000 being the numerator, plus 100,000 times 5%, 0.05. So that's going to be 5,000 this, but multiply it by 0.75 for the tax shield and divide that by, okay, in the denominator, we've got 312,000. So that gives 2.42 when rounded. And that is, once again, our diluted EPS. I report this as diluted EPS, or I mark this as the correct answer because it's lower than basic EPS. The point is, if it were higher, I would have to stick with the basic EPS. If it were the same, well, I would report the same figure for basic and diluted. Number 7, now we get on to options, and this is where we use the Treasury stock method. A company has 40,000 stock options outstanding with an exercise price of $19.5. The average market price during the period was $48.75. Using the Treasury stock method, how many incremental shares are added to the denominator? So with options, you're only going to make an adjustment to the denominator of the fraction, not the numerator. In this case, we're asked just for that adjustment to the denominator of the fraction, how many so-called incremental bonus shares are being added. So what you've got to do here, and this is obviously something I covered in the video preceding this quiz, is that you have to compute the proceeds from exercise. What would happen if the options were exercised? Well, 40,000 shares, options would be exercised at a strike price or exercise price of $19.50. So let's do this computation. 40,000 times 19.5. $780,000 would flow in. And this money, we now assume, is used to repurchase stock in the market. So number of shares repurchased using those proceeds above. And the whole point of this method, or the whole trick, is to assume that we use that money, we use those funds to repurchase stock at the current, most recent average price at which that stock was trading. So if the stock was trading at 48.75, that's what we use. We divide this by 48.75 and see how many shares we would be able to purchase in the market. Okay, 16,000. And now, what's the actual adjustment to the denominator of the fraction? It's not going to be 16,000. So that's the wrong answer. What we actually do is take the number of shares that the options will convert into, or may be converted into. So 45, we call this the incremental shares, the additional shares. So the company will, if the options are exercised, the company will have to issue 40,000 shares. The money from the exercise of the options would suffice, would be enough to purchase 16,000 shares in the market. And we deduct that 16,000 to arrive from the 40,000 to arrive at a figure of 24,000, because the assumption is that's how much, that's the number of shares the company would need to issue essentially for free without getting commensurate compensation for it. The compensation or the proceeds from the exercise of the options would only suffice to purchase 16,000 stock shares in the market to give as part of the option exercise, and the rest would have to be issued kind of without compensation, without due compensation, or for free. That's the adjustment we make, the 24,000. Hence, the answer to question 7 is 24,000, or answer B. Now, on to question 8, which actually, if you just quickly look at it, glance at it, and compare it to the previous one, uses the same, pretty much the same numbers. It's actually the same in terms of the numbers used. And now the question is, what is the diluted earnings per share here? So we go one step further and we compute the actual figure. Always start with basic. When asked to compute diluted, start with basic. Although, with shares, options on shares, that's it's very rare that you're going to get a diluted earnings per share that is not lower than basic, unless the exercise price is higher than the average price in the market. That's the only case, and I think we've got a question like that later on as well. So basic EPS, take the net income of 1 million from up here and divide by the current number of shares outstanding, which is 400,000, or the weighted average. So once again, 2.5, you'll see that I have a liking for 2.5 because you often see 2.5 being the answer. Let me just check if that's correct. 1 million divided by 400,000. That is indeed 2.5. And now for the DEPS. We take the net income that the company already has. We make no adjustment to net income because the exercise of options doesn't provide any economies in terms of net income available to ordinary shareholders, but it does increase the number of shares. So the existing number, 400,000, which goes into the sort of as the starting point of the denominator, that gets increased by how much? Well, by those incremental shares that we had in the previous question. I'm using that number, not computing it again, because obviously the data is the same across the two questions. So effectively, we've got a million divided by 424,000. And we have 2.36 when we round the answer to two decimal places. So that's B. Is it B? No, that's C. Sorry. I'm highlighting answer C, but saying B. No, it is answer C. Just to confirm, C. Okay. The next question is a very theoretical one. No numbers need to be crunched here. Why is the after-tax interest rather than the pre-tax interest added back to the numerator when applying the if converted method to convertible debt? Well, hopefully I've said this enough times for you to now be comfortable with the answer. It's because interest, on the one hand, is an expense, but it also provides a bit of relief when it comes to taxation. So if you assume interest is no longer going to be paid, which is what you should assume if convertible bonds convert into preferred shares, so ordinary shares, then you economize on the interest, but you lose the tax saving. Hence, answer A is correct. Not paying the interest removes its tax deduction, so only the net of tax saving is recovered. That's the pretty much the answer. Number 10, a potentially dilutive security would, if included, produce an earnings per share figure higher than basic earnings per share. How is this security treated? Well, we haven't had such a case yet in the questions being solved, but we will in the future. If something turns out to be anti-dilutive, we just ignore it from the computation, and that's what answer B suggests. It's not going to be included, it's going to be excluded. Let's do question 11. A company reports net income of 900,000 and has 300,000 weighted average shares outstanding. It has 25,000 convertible preferred shares, each paying an annual dividend of $6 and convertible into 2 common shares. What is the diluted earnings per share? Okay. So start with basic. As always, take the 900,000 of net income. Now, because we're dealing with convertible preferred shares, the computation of basic EPS is actually a little bit complicated because you need to have you need to make sure you adjust this number downwards to arrive at the net income available to ordinary shareholders. So the ordinary shareholders get whatever is left after the preferred shareholders have received their dividend. So 25,000 convertible preferred shares exist, paying an annual dividend of 6 each, right? So you have 900,000, the net income, which is available to all the shareholders, ordinary and preferred, but minus what gets paid to the preferred, leaving the amount available to the ordinary shareholders. And in the denominator, we, for the time being, just have the 300,000. So weighted average number of shares outstanding, 900,000 minus 25,000 times 6. So 750,000, divide that by 300,000 number of shares outstanding, and surprise, surprise, we get another 2.5. DEPS, diluted earnings per share, now is going to be, take the net income, and once you assume that the shares have already converted, you will no longer be paying this. So you basically don't need to make any adjustment anymore, any downward adjustment. We ignore that. But in the denominator, we see what happens when those additional shares are created. And each instrument, each of these 25,000 convertible shares was supposed to convert into 2 common shares. So I'm adding 25,000 times 2. And effectively, we've got 900,000 divided by, 350,000. Okay, and that gives a number of 2.57. Now, you would be, the computation thus far is absolutely right, but 2.57 is not the right answer. You don't just go and take the number from the if converted method and plug it in and say that's the DEPS, because you have to check whether it isn't by any chance higher than basic EPS. And that's exactly what we had in question 10. A potentially dilutive security in the form of convertible preferred shares produces a number, an earnings per share figure, which is higher than basic EPS. What do? You exclude it. You treat it as anti-dilutive, so you don't report 2.57. You stick to basic EPS as your DEPS figure. So answer B is correct because it's dilutive. We ignore it and we just stick with basic. 12. A company reports net income of $600,000 and has 200,000 weighted average shares outstanding. It has $200,000 worth of convertible bonds carrying an 8% annual coupon convertible into 16,000 common shares. The tax rate is 30%. What is diluted earnings per share? Okay. You should be by now able to cope with this, fairly easily on your own. It's, we've done questions like this, so there isn't anything stopping you. If you've thus far been just following my my computations, please, trust yourself to do this one, or at least attempt to do this one. We start with basic EPS. As always, 600,000 net income provided. Okay, what do we have? We have convertible bonds. So for the purposes of computing basic EPS, you can be sure that any interest on the convertible bonds has already been included in the net income figure. So when you do basic EPS computation, you can assume that this is the net income available to ordinary shareholders in the absence of any preferred shares, which would pay a preferred dividend. We divide this by 200,000. The weighted average number of shares, 600 by 200,000 is 3. Okay, now for diluted earnings per share, take the 600,000 of income, and now, assuming the the convertible bonds have indeed converted, we will no longer be paying the interest, and we add back the after-tax effect of the interest. So 200,000 worth of convertible bonds, 8% annual coupon, so times 0.08, and times the 1 minus the tax rate, so 0.3. That is the expression. And by the way, in the exam, you also need to practice solving these questions without writing anything down. There is nothing really to say that you have to write all of this out. It's just it's a lot of time. So realistically speaking, you can just take your calculator and start punching in those numbers, but you have to kind of practice a little bit to make sure you know what you're doing. In the denominator, take the obviously the existing weighted average number of shares, the 200,000 that we also used for the basic EPS computation, and now increase that for the number of additional shares that are being created upon the conversion. That's 16,000. Right, so take my calculator and do 600,000 plus 200,000 multiplied by 0.08 multiplied by 0.7, namely the 1 minus tax rate, equals, and divide by 216,000. Okay, 2.83 seems to be the answer. It's lower than basic EPS. I marked that as the correct one. Okay. Now, 13. A company reports net income of 2,300,000 and has 800,000 weighted average shares outstanding. It has 50,000 stock options with an exercise price of USD 31.50. The average market price during the period was $42. What is the diluted earnings per share? Okay. Let's do basic first, just for practice. But when you've got an exercise price 31.50, which is lower than the current market price, you're not going to get an anti-dilutive security. This will be dilutive. So to be honest, I'm doing EPS, but you don't have to do it. Actually, which probably means I shouldn't do it either, just not to waste time. But I'm going to do it. 2,300,000 divided by 800,000. Let's see what that is. Obviously, I took the figure for net income, and divided by the number of shares outstanding, 2.88. For the purposes of computing DEPS, you have to follow that Treasury stock method. So you have to start off with the computation of the exercise proceeds. How much money would the company receive if the options were exercised? How many options do we have? 50,000 stock options with an exercise price, each one of 31.50. So upon exercise of those 50,000 options, we would assume the company receives total proceeds of 1,575,000. Okay. And next question is, how many shares would that enable in terms of repurchasing them in the market at the prevailing market price? So $1,575,000. Now, the average price of the shares in the market over the period was 42. So take that figure, divide by 42, and that would enable the repurchase of 37,500 shares, which is quite a lot, or a significant majority of that 50,000 that the stock options would convert into in terms of ordinary shares. But there is still a certain number of shares, we call those incremental shares, that would need to be issued by the company. And it's only those incremental shares that we care about from the point of view of adjusting the denominator of the EPS fraction. So 50,000, if you're not told otherwise, assume each option allows the holder to purchase one ordinary share. So 50,000 options allow the purchase of 50,000 shares, minus that 37,500. Of course, the difference is 12,500. That's the shares that the company would need to kind of issue for free without commensurate compensation. The EPS, therefore, becomes 2,300,000 divide by the existing number of shares outstanding, and now add this 12.5. We're increasing the denominator of the fraction without doing anything to the numerator, so we're going to get dilution. 2,300,000 divided by 800,000. Oh, I didn't open a bracket, sorry. 2,300,000 divided by open bracket 800,000 plus 12,500, close the bracket. 2.83, that's the answer. Bingo, answer B. Not so bad, hopefully. I mean, I know it took a while for me to solve this, but I'm talking, I'm writing things down. In the exam, you don't have to write everything out. It's not an essay, just get the stuff over and done with, compute the right answer. And then 14, a company has 10,000 stock options outstanding with an exercise price of 61.25. The average market price during the period was 49.50. Good. How are these options treated under the Treasury stock method? Now, in all honesty, I would see this very much as a question that is not theoretical but numerical. And the thing you have to spot immediately, so as not to waste time, is the fact that the exercise price on these options is 61.25, which is way higher than the prevailing market price. So even if you assume that the options get exercised, the proceeds from the exercise would more than enough cover the repurchase of shares in the market. So there would be no incremental shares. You wouldn't have to buy any additional shares in the market. These instruments are therefore anti-dilutive, these options, given the current market price of shares. Obviously, when and if the market price of the shares changes and goes up, they may become dilutive, but not yet. They are anti-dilutive, answer A. The rest of the answers is, kind of talking about what you should add or what these shares add. They don't add anything. Right, a company has 35,000 stock options with an exercise price of $24.50. The average market price during the period was $49 using, okay, so here it's kind of that way around, assuming, and we can safely assume these instruments are going to be dilutive because the exercise price is much lower than the current market price. Using the Treasury stock method, how much cash is assumed received and how many shares are assumed repurchased? So not asking us for the full DEPS computation, but just the computation, just elements of the incremental shares computation, not even the whole one. So cash received or proceeds received from the exercise of the options, 35,000 of these instruments. Exercise price 24.50. Let's see. 35,000 times 24.50. 857,500. Okay, so this boils the choice down to answers B and C. Just probably something we could have guessed, given how these answers are phrased. Shares repurchased now. So with that money, 857,500, and the prevailing average market price of the shares 49. What could we repurchase? 17,500. So answer C provides the correct combination. We don't need to go anywhere beyond that. Don't need to compute anything else. That is very much it.